Good afternoon, everyone. Thank you for joining me for Terminology Tuesday. Today we're going to have a conversation on why does a lender need to see credit in order to approve you for a mortgage in most cases. I'm going to read to you a little bit from a report that I read to help maybe better understand and explain. It's been getting tighter, obviously, over the years. A lender needs to see that you pay your bills, and the only way that they can see that is through a credit report. Lenders want to see that you've been borrowing and repaying relatively small amounts of money for a year or for a while before they sign off on what is likely going to be the biggest loan of your life. If you don't have a borrowing history, then they don't know a whole lot about you, and they have no other way of finding out other than through an Equifax report, and the other one is TransUnion. It's a bit like trying to get a car insurance. It's better to be someone who's been driving for 10 years and has had a couple of car accidents than if you just got your driver's license and have never driven a car. You don't have to have a credit card necessarily to build credit, but lenders do like potentially to see both. A small credit card, a limit that's in that 1,000 probably as a minimum range, and not using it for more than 50 to 60% of the balance at any given time. They want you to see you using it on a consistent basis, and the other potentially a loan, line of credit. If they see one revolving, one installment, it gives them an idea that when you do make that revolving loan or payment, and it's a little bit more requirement of your going and making that payment on a revolving than it is on a car loan or any other personal loan, because those usually come automatically out of your account. The general rule of thumb is 2 years, 2 lenders. If you don't have that, there are alternative methods as well that they can look at and potentially could, depending on amount of down payment, depending on the lender. An alternative can sometimes be rent. So sometimes they will look at a year of rent, a year of utilities, if you've been renting for a long period of time. Those tend to be exceptions to the rule. You do definitely want and need to have some credit on your bureau. Bill paying is, and how you pay it, is a predictive power. So how they can see over the years of how you have paid can tell them a lot. Now, there's certain times in one's life that things happen, illnesses, job losses, issues in the family that can cause some concerns. Those can sometimes be explained away, but most often it's tough if they're current. So again, it's just an indicator of what the lender needs to look at to see that you're a responsible bill payment and you've been doing that for a period of time. And that's why they kind of like to look at it that way. And until they come up with another system, that's what we've got. But anyway, thank you so much for joining me. Brenda McKay, Advanced Mortgage, 403-347-0774, and have a wonderful day.